Imagine it's early 2026. The headlines are screaming victory. Senior administration officials are on every channel, forecasting an economic boom. You see the numbers yourself. The economy just grew at 4.4%, the fastest pace in 2 years. It feels like a corner has been turned. Your retirement account is finally breathing again. But while the media celebrates the growth, they're ignoring a much bigger number, a toxic number. Deep in a government report, a watchdog has issued a stark warning. The $38 trillion national debt is now a runaway train, growing faster than the economy itself. This isn't just a political talking point anymore. It's a mathematical certainty. The entire American financial system, the very dollars in your bank account, are built on a promise that is quietly becoming impossible to keep. And the plan for what comes next has already been set in motion. To understand how we got here, you have to rewind the clock. Not to the Founding Fathers, but to the 1980s. This was the moment America's economic DNA was rewritten. A new philosophy took hold. You could have it all, massive government spending and lower taxes. It was a promise of prosperity without sacrifice, the birth of an idea I call the Great Uncoupling. For the first time, what the government spent was fundamentally uncoupled from what it earned. This was the original sin. Before this, debt was a tool for emergencies, for world wars or deep depressions. Afterward, it became a lifestyle. We put the national economy on a credit card, and for decades, the party rolled on. The minimum payments were manageable. The credit limits seemed infinite. Foreign nations were more than happy to lend us the money, eager to park their cash in the world's most stable economy. But the balance never goes away. It just grows. Quietly at first, then with terrifying speed. Think about the numbers. The total federal debt didn't cross the $30 trillion mark until February 2022. Less than 2 years later, by December 2023, it was already over $33 trillion. By 2024, our total government debt had ballooned to over 124% of our entire country's economic output for a year. Imagine your personal mortgage being larger than your annual salary. Now imagine it growing faster than your yearly raise. That's the gilded cage we built for ourselves. Every crisis, from banking panics to global pandemics, became another reason to swipe the card. Each swipe added another layer to the debt, making the entire structure heavier, more unstable. This brings us to today. The headlines might scream, boom, but they ignore the tremors in the foundation, a foundation built not on production, but on decades of borrowed money. The bill for that 40-year party is finally coming due. And the question is no longer if we have to pay it, but who, exactly, is coming to collect. But this isn't about Washington. It's about your wallet. The headlines might look good, but this recovery is built on a dangerous illusion I call the penthouse economy. From the top floor, the view is great, but for everyone else, the foundation is cracking. While officials celebrate an inflation rate of just 2.7%, your purchasing power is quietly being drained. That $38 trillion national debt isn't an abstract number. It's a bill of over $100,000 hanging over you and every member of your family. It's a weight that pushes down on your wages and pushes up the cost of your mortgage, your car, and your groceries. This system, where the nation's health depends on the wealthiest spending more, leaves your future dangerously exposed. Your savings, your retirement, your children's opportunities, they are all tied to a ticking time bomb of public debt. The real crisis isn't coming. It's already in your bank account. So how did your personal balance sheet get chained to a national credit card with no limit? This isn't a new problem. It's a 40-year-old decision with the bill now coming due. To see the origin, you have to rewind to the 1980s. Under President Reagan, Washington made a fateful bargain. The promise was seductive. You can have massive tax cuts and huge government spending. The catch? It would all go on the national credit card. This was the birth of a political strategy I call the tomorrow engine. The rewards were immediate. The consequences were kicked down the road for a future generation to solve. And for decades, they were. One administration after another, regardless of party, kept the engine running. The cycle became predictable. Every crisis, every downturn, was met with the same prescription. Borrow more, spend more. The debt quietly climbed, then it began to sprint. Then it rocketed upward. It took the United States over 200 years to accumulate its first $1 trillion in debt. Now, we add that amount in a matter of months. The result is a staggering milestone. Today, The total United States national debt has crossed a critical threshold, 100% of the entire country's gross domestic product. For every dollar of value the U.S. economy creates in a year, there is now a dollar of federal debt. This created a profound structural weakness. America became addicted to cheap money, much of it borrowed from its global competitors. For a long time, the world was happy to lend, funding this consumption. But they weren't doing it out of generosity. They were a crucial part of a global system, a hidden mechanism that made the dollar king. A mechanism that is now quietly being taken apart, piece by piece. So how does this illusion stay afloat? It runs on a hidden engine I call the shadow subsidy. To understand it, imagine the global economy is a giant casino. To play any game, to buy oil, to trade goods, to invest, you need the house's chips, and those chips are US dollars. Now, imagine the casino owner, the United States government, can print an infinite supply of new chips for itself whenever it wants. That's the secret. It's the privilege that underpins the entire system. Here's how it works, step by step. First, countries around the world need dollars to do business. From Riyadh to Rio, the dollar is the language of global commerce. So nations and their central banks have to keep massive stockpiles of dollars on hand. Second, they can't just let that cash sit there. They need a safe place to park it. The safest, most liquid dollar-denominated asset on Earth is U.S. government debt, treasury bonds. So they lend their dollars back to the very country that printed them. This creates the final, crucial step, a permanent, massive, artificial demand for American debt. It's a fire hose of cheap credit aimed directly at Washington, D.C. This subsidy from the rest of the world is what allows the U.S. to spend trillions more than it takes in, year after year. It's what allowed the national debt to soar past the size of the entire U.S. economy, a critical milestone of 100% of gross domestic product. For decades, this was the best game in town. But look closely, and you can see other players quietly cashing in their chips. You see it when Canada cuts a new trade deal with China. You see it when the EU signs an agreement with South America, sidestepping the dollar entirely. This isn't just a theory. The shadow subsidy is a machine with a fatal flaw, one that becomes obvious when you look at the raw numbers. And the math reveals a countdown clock. The first casualty wasn't a market crash, it wasn't a bank failure. It was a quiet signature on a piece of paper, an event that barely made the evening news. The country was Canada. For over a century, America's closest ally, its most stable trading partner. But in the corridors of power in Ottawa, a cold calculation was being made. They looked south at the United States, a nation boasting of growth but drowning under a $38 trillion mountain of debt. They saw the political gridlock, the endless borrowing, and they made a choice. They signed a landmark new trade deal, not with Washington, with Beijing. This is the first stage of the dollar's decline. It doesn't happen with a bang. It happens with a series of quiet goodbyes. I call it the ally exodus. It's not a betrayal. It's a survival strategy. Imagine you own a small manufacturing plant in Ontario. For your entire life, your biggest clients were in Ohio and Michigan. Your contracts were in US dollars. Your supply chains were a few hours, drive across the border. Now, your government is offering you subsidies to retool your factory, to meet the standards for markets in Shanghai and Guangzhou. Your business, your life, your future is being rerouted in real time. This isn't an isolated event. Soon after the Canadian deal, the European Union finalized its own free trade agreement with the powerhouse economies of South America. Think of the global economy as a neighborhood. For 80 years, everyone did their shopping on Main Street, USA. Now they're building new shopping malls on the other side of town. Each one of these deals is a new store opening up, a store that doesn't have to price its goods in American dollars. Every new agreement is another brick taken from the foundation of the old system. While the headlines in America focused on domestic growth, the spreadsheets in foreign capitals were telling a different story. They were adding up the risk. And for the first time, the risk of staying tied to the dollar was becoming greater than the risk of leaving. But this was just the beginning. So how does this illusion stay afloat? It runs on a hidden engine, a mechanism I call the sovereign loophole, and it works in 3 simple steps. First, the U.S. Government spends far more money than it collects in taxes. Billions more, every single day. To cover that gap, the Treasury Department issues debt in the form of bonds. Think of these as IOUs, promises to pay the money back later with interest. For decades, the rest of the world eagerly bought these IOUs. It was the safest investment on the planet. But now, we have the second step. The buyers are disappearing. Longtime partners are cutting new trade deals that bypass America entirely. They don't need as many dollars, so they don't need to buy as much of our debt. This creates a terrifying problem. What happens when you're throwing a party, but nobody wants to buy your IOUs anymore? Who funds the deficit? This is where the loophole opens. The third step is the quietest, but the most important. The Federal Reserve steps in. It creates money out of thin air, digital dollars on a computer screen, and uses that new money to buy the government's debt. It's the financial equivalent of paying off one credit card with another, one you own the printing press for. Most people miss this because it's designed to be missed. It's a transaction between two buildings in Washington, D.C. That changes the value of everything you own. It doesn't feel like a tax. There's no line item on your paycheck. But the cost is real. Every new dollar created to paper over the deficit dilutes the value of every dollar already in existence. The money in your bank account, your retirement fund, your wallet, it all loses a tiny fraction of its purchasing power. It's a slow, invisible bleed. While headlines celebrate growth, the reality is that our prosperity is being financed by a ghost engine, burning our future savings as fuel. This isn't a political opinion. It's an accounting reality, and the math behind it is brutal. When you track who is buying the debt versus how much debt is being issued, you don't see a forecast. You see a countdown. If the Canadian deal was a single wire being cut, what followed was the entire switchboard being ripped from the wall. While the president was in Davos, Switzerland, outlining a vision of American economic dominance, two continents were quietly making that vision obsolete. The European Union and South America finalized a new, sweeping free trade agreement. It barely made a ripple in the American news cycle. It should have been a tsunami. This wasn't just a bigger version of the Canadian problem. This was a change in kind. A systemic shift. Think of the global economy as a complex piece of software. For 80 years, every transaction, every line of code, ran through a central server located in the United States. This new pact began writing a parallel operating system, one that didn't require American permission. I call this phenomenon the Great Detour. The world was no longer trying to reform the old highway. It was building a new one and leaving America's toll booths behind. Washington saw none of it. The Canadian pivot was dismissed as an outlier, a petty reaction from a spurned ally. The lesson was not just unlearned. It was actively ignored. This new transatlantic alliance wasn't a reaction. It was a strategy. A quiet, coordinated effort to build a financial architecture that could withstand shocks from Washington. While America's national debt ballooned to over $38 trillion, these nations were building an escape hatch. The math had become terrifyingly simple. With a government debt-to-GDP ratio climbing past 124%, the United States was no longer seen as the world's safest bet. It was starting to look like its biggest liability. Each new trade deal signed without American involvement was a vote of no confidence. A quiet recognition that the country underwriting the global system could no longer afford to pay its own bills. The cascade was accelerating. First, a key partner. Then a coalition of entire continents. Each step normalized the idea of a world without America at its center. And here's where it gets personal. The numbers don't lie. And right now, they're screaming. Forget the official forecasts and the speeches from Davos. Let's do the math ourselves. The U.S. national debt has crossed $38 trillion. But it's the velocity of that number that reveals the truth. Little over 2 years ago, that figure was $33 trillion. That's a $5 trillion increase. What does that look like in real time? It means the government is borrowing an additional $75,000 every single second. Before you can even process that number, your share of the new debt just went up. This isn't just unsustainable, it's a countdown. This acceleration has pushed us past a terrifying milestone, a point of no return. I call the debt singularity. This is the precise moment when the debt itself begins to grow faster than the entire American economy that's supposed to pay for it. Imagine trying to outrun your own shadow. You can sprint for a while, but eventually you get tired. The shadow never does. And you feel this every single day. You feel it when the consumer price index quietly ticks up another 0.3% this month, making your groceries just a little more expensive. The cost to simply service this debt, not pay it down, just pay the interest, is now a financial black hole. It pulls in hundreds of billions of dollars that could have been invested in technology, infrastructure, or your future. This is no longer a political debate, it's a math problem. And a math problem this big, with a fuse this short, only ends in a few ways. So what happens when the numbers finally break the system? What does day one of the crisis actually look like? Now you might be thinking this is just doomsday talk. And you'd have a strong case. Skeptics will point to America's incredible resilience. They'll show you forecasts from firms like Vanguard predicting unemployment will settle near a healthy 4%. They'll highlight that inflation recently came in below the forecast of 3.1%. They will argue, correctly, that there is no other currency on earth ready to take the dollar's place. No other country has markets as deep or as liquid. This is the ultimate defense. There is no alternative. This argument is powerful because it's partially true, but it focuses on the symptoms while ignoring the disease. It's a phenomenon I call the durability illusion. The illusion is that the economy's strength is organic. The reality is that its health now increasingly depends on the spending of a tiny, wealthy minority. This isn't a recovery for everyone. It's a private boom for a select few, financed by public debt. While the headlines celebrate a strong consumer, the spreadsheets reveal a nation where the national debt is set to grow faster than the economy itself. A government watchdog didn't call this a risk. They called the future crisis almost inevitable. The dollar isn't going to collapse tomorrow. Its defenders are right about that. The system is too big, too entrenched. It's like a giant oak tree that looks strong but is slowly being hollowed out from the inside. The danger isn't a sudden storm that snaps it in half. It's the slow, quiet rot that guarantees its eventual fall. But even if they were right, so where does this road end? The path forward splits into two distinct futures, two very different Americas. First, there is the most likely scenario, a future I call the slow squeeze. This isn't a dramatic collapse you'd see in a disaster movie. It's a quiet, creeping erosion of wealth. The dollar remains the world's primary currency, but its dominance frays at the edges. More international trade bypasses it completely, following the path already cut by new agreements between Europe and South America. For you, this feels like running on a treadmill that's slowly speeding up. Your salary stays the same, but your grocery bill climbs. Inflation becomes a permanent house guest, never high enough for the evening news to panic, but always present, silently eating away at your savings. The system doesn't break, it just grinds you down. Then there is the second scenario, the unraveling. This is the financial heart attack. A major creditor, perhaps China, perhaps a coalition of oil states, decides the risk is no longer worth the reward. They begin to sell their holdings of U.S. debt, not all at once, but enough to spook the market. A quiet electronic signal triggers a global stampede for the exits. To fund its own government, Washington is forced to offer punishingly high interest rates, choking off credit to American businesses and families. A deep, painful recession follows. The probability is low, but it's a true black swan event, one that would redefine the global financial order in a matter of weeks, not decades. Of course, there is a third path, one where the skeptics are right and American ingenuity finds a way to defy financial gravity once again. But I can hear the objection now. It's the single most powerful argument for the status quo, the one that has silenced critics for 50 years. The U.S. dollar is inevitable. They'll point to the deepest, most liquid financial markets in human history. They'll show you the world's most dynamic companies. In this view, America's debt is a feature, not a bug, the price of being the global anchor, the indispensable nation. For decades, that argument has been almost entirely correct. It's the reason why every prediction of the dollar's collapse has been wrong. But that argument is now running on fumes. It misses the fundamental change happening beneath the headlines. This isn't about a sudden crash. It's about the slow, corrosive decay in the quality of American growth. The system's resilience is becoming a mirage. While the stock market soars, the data shows the real economy is increasingly dependent on the spending of only its wealthiest citizens. It's a recovery that looks great from a private jet, but feels very different on the ground. Even optimistic forecasts from firms like Vanguard see unemployment settling around 4.2%. That's not a boom. It's a permanent state of anxiety for millions. I call this structural split, the great fracture. This isn't an accident, it's a choice. A system that generates headline growth while leaving the majority behind isn't broken. It's working exactly as designed. And it forces us to ask a much more uncomfortable question. Not if this path is sustainable, but who, exactly, does it sustain? So what am I doing with my own money? Before I say another word, a critical warning. This is not financial advice. It is a journal of my own strategy, a framework for navigating the storm I see coming. You must do your own research. My approach is built on a principle I call the asymmetric hedge. The vast majority of my capital, 90%, stays in conventional, diversified assets. But the final 10% is different. That is my hedge, positioned specifically for the dislocation we've been discussing. It's my insurance policy against the math we just walked through. My eyes are not on the daily market noise. They are locked on specific triggers. I'm watching for the next major trade agreement, like the ones Canada and the European Union just signed, that bypasses the dollar system entirely. When another G7 nation cuts a direct deal with a rival power, that's a signal. My position sizing is tied directly to these events. If one of those triggers hits, my hedge might scale from 10% to 15%. If two hit in the same quarter, it could go higher. But protecting against the downside is only half the story. Because the most counterintuitive, most dangerous, and potentially most profitable event may not be the slow decline itself. It could be the final, manic rally that precedes it. The headlines will keep promising a boom, a party without end. But you've seen the math behind the illusion. This isn't about predicting a single crash. It's about a fundamental shift, a slow, grinding transfer of wealth that's already happening. The critical question is no longer if the dollar's dominance will fade, but how you will protect yourself during the transition. The financial playbook of the last 50 years is now a trap. A new map is needed for the territory ahead, and understanding it is the only move that matters. Our next investigation charts that map, exploring the new rules of money and the assets built for this new era. The great unraveling has begun. History will not ask for your permission.